Hey all, welcome to Share Trek. This is Raj here. Friends, today we want to investigate one of the aspects of the most consequential economic events of our time, the US China tariff war. As a retail investor, I've been trying to get as much information as possible to game out the future prospects of the stock market. I want to share with you what I have found, and I will be taking you through the devastating and often irreversible damage that tariffs have inflicted on both the nations, China as well as US, and the overall global economy. And I have receipts to prove it. I'll be showing you some articles that detail all the information. I'll also leave links for the article in the description section so that you can check it out for yourself. So with that said, let me start off with the very first article, which talks about Chinese exporters abandoning the US market. So this article comes to us from Q Captain, or is it G Captain? It's a shipping website, and I think it has got really good industry information that can be very valuable for any investor from time to time, especially when you have pandemics or when you have these kind of tariffs and supply chain kind of a issue. I think this should be our go-to place. And the article I'm referring to here is titled Chinese Exporters Retreat from US as Tariffs Erode Profitability. So our first piece of evidence comes from this, and this was also published in Bloomberg's April reporting on Chinese exporters, the same article. And with tariffs now at staggering 145%, many Chinese manufacturers have completely halted shipments to the United States. These aren't temporary pauses, they represent permanent strategic shifts. Consider the factories which have spent years, sometimes decades, building relationships with American retailers and consumers. Many have now cut production to just 3 to 4 days per week. As one industry association representing 3,000 exporters put it, businesses are now in pure survival mode. Perhaps most telling is the story of a Guangzhou-based retailer selling underwear and yoga pants through Amazon and other platforms. Their management team made the definitive decision to stop fighting for the US market after urgent meetings in March. They have increased prices by 30% on popular items simply to generate cash while they pivot away from the American consumers entirely. This isn't about waiting out temporary tariffs, as Jenny Wang from Ningbo Curtain Maker explained. Her company is exploring new markets in Southeast Asia and Middle East instead, and with 90% of their client base suddenly gone, they can't afford to wait. The damage is already done. Even if tariffs disappear tomorrow, these business relationships have been severed and trust has been broken. Supply chains have been rerouted, and as one expert explained, when tariffs were at 54%, people suffered slim profits but still stayed to buy time. But at 145%, people decided to quit it entirely because you'll die faster if you insist on staying in the US. That's the gist of this particular article. Now, I have the next article for you, and the next article tries to compare the shipping collapse that has happened right now because of the tariff issue between China and the US, and in fact most of the world, and it compares that to the pandemic disruption. So let me take you to the article and walk you through what it is trying to say. I've condensed most of these articles so that you can understand the story that we are building out here, the conclusions when I draw that, you'll be able to follow it. So just let's go to the article. In this particular article, they are looking at the shipping industry where the impact is perhaps even more dramatic. Container bookings from China to the US have collapsed by over 60% in just 3 weeks since the new tariffs took effect. Industry experts are describing this as unprecedented, with container shipping facing macro headwinds. It has never encountered these kind of headwinds before, even during the pandemic, and ocean carriers have already cancelled 81 sailings for April in the Trans-Pacific trade lane. That's more than 51 sailings cancelled during the peak of the pandemic. This is the comparison with the pandemic. And the National Retail Federation has dramatically revised import forecasts downwards after 19 consecutive months of growth, and they are now projecting May volumes to drop 20.5% year over year, with June potentially seeing an even steeper 26.6% decline. What's crucial to understand is that shipping lanes can't simply be turned back on like a light switch. Ships are already being repositioned to other trade routes. If tariffs were suddenly relaxed, we could see a bullwhip effect with pricing surging, potentially approaching the levels seen during COVID crisis for shipping containers, as container rates from China to the US at that time reached nearly $20,000. The sudden shortage of containers would then cost to the increase in the price, and therefore these kind of things are very intricate and irreversible. And as Craig Fuller, CEO of FreightWaves, put it, the economy has COVID, except there is no PPP or stimulus coming. The only cure is de-escalation of the tariffs. But even with de-escalation, the shipping infrastructure has already been fundamentally altered, and getting it back to where it was is going to take time and a whole lot of money in the interim. So that's the way this particular article puts it. The next article talks about the destabilization of ocean liners. So this is the next article that we are looking at, and I want to explain a little bit out here, because this is something that I was not aware of until I came into this website, this shipping specific website, and this is pretty scary in my opinion. So the headline here reads, Trump's China-built ship fees spark chaos in global carrier alliances, and it says the USTR fees for China-built shipping threaten a complete destabilization of ocean alliances. So I was wondering, what is USTR fees? So I just went into the link to have a look at what USTR fees is. So this is another article that explains it. Trump's 100% tariff proposal on Chinese cranes could leave US ports with no good options. So it says here, Chinese cranes that load and unload containers from ships are the latest target of the Trump administration's attempt to boost domestic manufacturing, even as no US industry for the equipment exists. So just get this, there is no crane manufacturing industry for shipping in the United States. It's all coming from China. So the US Trade Representative is proposing duties of up to 100% on Chinese ship-to-shore cranes, containers, and other parts, because no company currently makes such cranes in the US, and it would take at least a decade to build up the industry, said Gene Seroka, Executive Director of the Port of Los Angeles. So basically the approach that has been taken by the Trump administration is that if you don't have a particular industry in the United States, just tariff the imports in that industry heavily, so that it will create opportunities within the United States, and then the industry will magically be built in the United States and we'll all be fine. So that is the approach. And in this article, what it explains is that the damage extends beyond individual companies to the very structure of global shipping. The upcoming USTR fees, specifically targeting China-built ships, threatens what experts call a complete destabilization of ocean alliances, the cooperative agreements that have maintained efficient global shipping for years. Consider that over 56% of all general cargo imports and some 90% of project cargo into America traditionally arrived on China-built vessels. From October, Chinese-built ships calling at US ports will face additional charges, eventually rising to either $33 per net tonnage or $250 per container discharged by 2028. This has created a two-tier shipping system where carriers with box ships exempt from penalties are trying to insulate themselves from partners with Chinese connections. As Nick Evans, a business development manager at AFS Global, explained, shipping lines with links to China will become unattractive to freight forwarders. The COSCO Group, the world's fourth largest liner group, faces a major headache, according to shipping analysts. Their best strategy relies on finding arrangements with alliance partners, but these alliances are already fracturing under the pressure. And even if tariffs were removed tomorrow, these shipping alliances, built on years of cooperations and optimizations, have been fundamentally damaged. The trust required for international cooperation have been eroded in ways that will take years to rebuild. The next evidence comes from Hapag Lloyd, which is a big shipping company. They are talking about a 30% drop in shipments from China to US. So let me walk you through that, the gist of the article. And once you look at all of these articles that we are seeing, I've got one more article after this. Once you see the collective of all of those things, you'll get to understand that this is not just a simple tariff issue, but it's something that fundamentally tries to alter everything that we do in the supply chain, in manufacturing, in global economics. So it's much bigger than that. And once we have set those things into motion, it's unpredictable how it will all turn out as we go ahead. Here is the article I was talking about. And it is titled Hapag Lloyd says 30% of China's US bound shipments have been cancelled. And they have reported that customers have cancelled 30% of shipments to the United States from China. So this is not fake news. It's actually coming from the source itself. But here is where we see the permanent restructuring according to this articles. There has been a massive increase in demand for consignments from Thailand, Cambodia, and also from Vietnam. So there is this rerouting that is taking place. They are permanently redirecting their supply chains. And this shift means companies are using smaller vessels on routes to the US in some cases, creating inefficiencies and increased costs that will ultimately be passed on to the consumers. The IMF has already warned that the global economic output will slow in the months ahead as these steep tariffs begin to bite, and even optimistic statements from officials about potential progress do little to undo the restructuring that has already occurred. And the next article I have is talking about the blank sailing crisis. This article was published on the 21st of April and talks about a massive surge in Trans-Pacific blank sailings amid US-China trade relations. So this kind of a tension has caused a lot of inefficiencies, and this particular article reveals that the scale of shipping disruption is immense. Blank sailings or cancelled shipping trips have exploded on the Trans-Pacific routes. Total blanked capacity for recent weeks surged to 367,800 TEU, up from just 60,000 TEU 3 weeks prior. The Asia-North American West Coast trade lane has seen scheduled capacity drop by 12%, while the Asia-North America East Coast route experienced an even steeper decline of around 14%. And as industry experts at Sea Intelligence note, the current political climate is extremely volatile, leading both shipping lines and cargo owners to make short-term arrangements and adjustments while waiting for stability before committing to longer-term changes. And this has also led to a ripple effect on the US economy. Now let's examine how this shipping collapse impacts the American economy, starting with the ports. The Port of Los Angeles, America's busiest container port, supports approximately 1 in 9 jobs across LA County. While container volumes drop precipitously, the impact cascades immediately. First, thousands of truck drivers who transport containers from ports inland find themselves without work. Many are independent operators who own their own trucks and have payments to make regardless of whether the containers are moving or not. Next, warehouse operations scale back dramatically. South California's Inland Empire, home to massive distribution centers for companies like Amazon, Walmart, and Target, faces layoffs and reduced hours as fewer goods arrive to be in the facilities. And port workers themselves, from crane operators to customs officials, see reduced shift and income. Surrounding businesses that support port operations, from restaurants to equipment maintenance, suffer an economic reduction in activities and contracts, volumes of business. But the impact doesn't stop there. As goods become scarcer and more expensive due to tariffs and supply chain disruptions, consumers face higher price across virtually every category. Electronics cost more and face delays. Clothing and household goods see price increases as retailers pass on tariff costs, and manufacturing slows as components becomes unavailable or too expensive. Home construction and renovation costs rise due to material shortages. So this is what we are looking at as a result of the tariff, and this is also supported by all the articles that I read to you and explained how the internals are working in the economy. And this has actually put us all as retail investors in a very difficult position. And my inquiry into all of these articles has been from the point of view of retail investors. So what did I conclude? My conclusion is that the tariff war's damage extends far beyond simple trade statistics. It has interrupted progress in research and development in critical areas, including disease control, as medical equipment and components face higher costs and delays. Apart from that, the DOGE cuts has reduced a whole lot of budget that was being given to R&D in medicine and other areas. All of those have gone. Universities and research institutions that rely on international collaborations have seen projects stalled. Medical devices and pharmaceutical research dependent on global supply chains have been disrupted, potentially delaying advances in treatments and cures. Even if tariffs were removed tomorrow, we have seen why the damage cannot be easily undone. Trust between business partners has been broken, supply chains have been permanently rerouted, shipping alliances have been fractured, manufacturers have abandoned the US market, and getting them back in again is going to be difficult. Workers have lost jobs that won't immediately return. And the US tariff moves have impacted every aspect of life on the planet and interrupted progress in research and development in critical areas, including disease control. This isn't just about economics, it's about the lost potential for human advancements when global cooperation breaks down. It has set back our progress as a race by many years, and we don't know how much because the talks have not yet started between China and US to resolve this. And in the last so many days, we had a target of 90 days to have all the tariffs negotiated between all the countries. We haven't seen a single negotiated outcome published so far. So it means that we don't know how long this is going to go on. That's where I think as retail investor, I'm looking at the rally in the market today. They could all happen because of short squeeze or the anticipation that the Fed is going to cut the interest rates in order to stimulate the economy and give some support to the markets. But I personally think that it's not the job of the Federal Reserve to take care of the stock market. Their focus is on the interest rates from an inflation control point of view and an employment point of view. So for generating employment, they may try to reduce the interest rate, but look at the uphill task. Not a single company in US produces the kind of cranes that are used in the ports. And with a 100% tariff on that, how soon can entrepreneurs scramble to get the money needed to create a factory, buy the know-how and the equipment to build those cranes? And can they be assured that in the near future, when I say near future, I'm talking about a long-term future, because if you put a factory with that kind of expenditure, and then if the tariffs are removed and all these fees are removed, then the tariff is going to, and then the company is going to be uncompetitive. So I am thinking that even US entrepreneurs, when they look at this tariff regime, they are going to be very cautious. They are going to look at how long these tariffs are going to be. Can we trust Trump that he's going to keep the tariffs in place? Has the Congress approved these tariffs? The answer is no. So the next president who comes in can, with the stroke of a pen, undo all of these things, and then the American companies which have set up production facilities to do all these things are going to find themselves at a very big disadvantage and huge losses because it's not sustainable. There are around 12 states which are filed a suit against the Trump administration, claiming that Trump cannot use the Wartime Act to put tariffs like this. And many of the smart business people are waiting to watch what happens in the court case. And if the court rules that Trump doesn't have the authority, then all this tariff thing is gone forever. And likewise, many countries are waiting and watching to see how it will go. They have seen how Trump handled Zelensky, and also they have seen the clip of Trump telling his donors in a meeting that countries are lining up, kissing his ass, saying that, please, sir, we want a deal. So all these kind of things make them apprehensive. And China has told upfront that they are not going to come in for deals unless US treats them with respect and as equal and with dignity. And now, having seen that Trump has blinked, they have said that no talks will begin until Trump removes all the tariffs that he has unilaterally imposed, and then they can come to the table, and the phone is always available for US to call them. So this is where we have left the whole thing, friends. And I'm going through all these things because I want to understand the internals. As a retail investor, my disadvantage is that I don't have a research team and I don't have in-depth knowledge. And I'm thinking that with the day of internet, we should have all the information available. So I'm digging deep. I'm looking at the shipping sources, trying to get information from the source to understand how much material would be there. My understanding from whatever I have read so far is that somewhere around middle of May, most of the people in US will start feeling the impact of the tariff, because things will get expensive and it will be also difficult to find the goods that they are looking for even after paying the higher amount of money, because there's likely to be shortages. So Trump has to do something very quickly, and as you saw, the internal workings of the shipping and the supply chain is such that turning it around is going to cost a lot of money and it's also going to take a lot of time. So in the meantime, the Chinese manufacturers and suppliers are not waiting for Trump to make up his mind. They're already looking for other markets. They're increasing their price for the goods, assuming that their scales are going to be suppressed. So the economics, they are saying that the economy of scale is going to go away because US is not purchasing. So they're looking for Middle East and other markets, and they have jacked up the price a little bit. And they are saying, okay, we'll survive. We survived without US before. We'll survive without US in the future. So that's the approach that they are taking. So that brings us back to our predicament as investors. So some of the things that an investor can do is move out of the US market and look at emerging markets. I'm going to do a series of videos on emerging markets, and India is a market in which I have extensive experience because I own a lot of stocks there. I used to be an active investor many decades ago when I was in India, but I have a passive portfolio which is very hefty. It has grown a lot. It's got a lot of blue chips in India. So I'm going to do a separate video on India, and I'm going to start studying on the Chinese market and the other markets. And I'm also going to find ways for Americans and North Americans as well as Europeans to deal in those kind of markets, the vehicles that we can use to invest in those kind of markets. And I'll make a series of videos later on that. So that's one thing that people can do: move out of US denominated assets into international assets, do a good deal of diversification. Then you got gold, you got Bitcoin and cryptocurrencies to look at. And you got, of course, European bonds and Japanese bonds and others. So there are a whole lot of opportunities out there apart from US. And if US decides to go this way, I think there's a tremendous amount of pressure on President Trump. And if President Trump does not respond to those pressures, we are indeed for a difficult time in the US stock market. And however much the Fed decides to print currency, what's actually going to happen is the US dollar is going to get weaker and weaker, because its purchasing power will go down with more dollars being printed. So it's going to be a band-aid solution, and the cost of gold is going to go up because gold is denominated in US dollars. So as the US dollar purchasing power goes down, gold will become more expensive. So these are all the dynamics that I visualize. So I'll think through this much more and come back to you with more videos. And this was me disclosing the way I'm looking at the markets. I would like your feedback. We have viewers from other parts of the world, and I would like your feedback so that we can jointly try to understand this beast and try to position ourselves much more effectively and reduce our risk for losses. With that, my friends, I'd like to bring this video to an end. Thanks and have a great day. Bye for now.